This is task 5, activity 3 of the Understand Money unit, the final activity in the course, and it is a short activity talking about the effect of interest rates on savings and borrowings. Okay, this is quite an important one actually to finish with. Now, if you remember, interest rates on savings, we want them to be as high as possible because that means that we get more money back for our savings. On borrowings, we want them to be as low as possible because that means we have to pay less back on the money that we've borrowed. Okay, and the interest rates that lenders for mortgages, credit cards, loans charge are usually based depending on what the Bank of England does. So the interest rate, the kind of general interest rate over the whole country is controlled basically by the Bank of England. Okay, the Bank of England interest rate it's called, and lenders will also kind of put their interest rate up if the Bank of England base rate gets put up. Okay, which means that's good if you have savings in the bank because you get paid more money in interest. But it means if you're borrowing money, like people that have, say, variable rate mortgages, or people that have credit cards, which is the vast majority of people, it means that you would then have to pay more back. Okay, so we're going to have a look at and see how the interest rates affect savings and borrowings in this. And just a couple of terms that I want to bring to your attention. So when you're looking at interest rates, you will see they're given as a percentage, and beside the percentage will be three letters. It will either be APR or AER. For example, on interest rate on a credit card, it might say something like 3% APR, interest rate on a savings account, it might say something like 2% AER. Now, APR, the P stands for you have to pay that. So it is the annual, it stands for annual percentage rate, and the P means that you have to pay that back. So this is for borrowing money. You will see APR beside the interest rate, and AER, you can think of the E as meaning earning. AER is for saving money. Okay, so just a couple of things, three letters, you'll see them in, adverts on the telly for banks, savings accounts, payday loans, that sort of thing. You'll see either APR or AER if you look beside the percentage, and that's basically what they mean. They mean annual percentage rate, and that is for borrowing money, and it's annual equivalence rate, and that is for earning money. Okay, so we're going to look at this activity 1 and look at these two situations. So we are going to assume that there are two savings accounts, and one will pay 1.5% AER, there it is, while the second will pay 2% AER. If you invest £5,000 in each account for 3 years, how much will you have in your account at the end of the 3 years? Okay, so this is a compound interest appreciation problem. So this is where we use our initial quantity, we get the multiplier, and we do it to the power of how many years. Okay, so we've got bank account 1 that has AER of 1.5%. Okay, the savings are going to be worth 5,000 multiplied by, well, what would that 1.5% increase be as a multiplier? So you can maybe do that at the side. Remember, it's 100 plus 1.5 equals 101.5%. What is that as a decimal? Divide it by 100, so 1.015. So we're just moving that decimal point back 2 places. So it's 5,000 times 1.015. Now that would be the interest earned if I just did that calculation. That would be the final value after just 1 year. I'm after 3 years, so I'm doing this to the power of 3. So get your calculator. 5,000 times 1.015 to the power of 3, and the value of the savings after 3 years, if you didn't touch that money, is then going to be £5,228.39. Now, bank account number 2, which has an AER, annual equivalence rate, of 2%, savings, that's going to be 5,000 times, now doing the same process over here, 100 plus 2, 102%, so 1.02 for the multiplier to the power of 3. So very similar calculation, just the multiplier that's different, times 1.02 to the power of 3, and that's given me 5,306 pounds. Sorry, £5,306 and 4 pence. So you can see that bank account number 2 with the higher AER rate, annual equivalence rate, gives me a higher amount of money at the end of the day. So when you are looking at savings account, that is the first thing you should be looking at, is what is that interest rate. If you are saving your money, you want that interest rate to be as high as possible. Okay, so we've had a task already about bank accounts and ISAs and that sort of thing. So just remember, when we are saving money, we want as high an interest rate as possible. Now we're going to look at an example of borrowing money. So before someone takes out a mortgage to buy a house or a flat, they should consider the effect a rise in interest rates might have on their monthly payments. Okay, so what it asks us to do is use that BBC mortgage calculator to check the monthly payments on a 30-year mortgage for £50,000 when the mortgage rate is 3%, 5% and 8%. Okay, so what this is basically getting us to do is using these different interest rates, how big a difference does it have when on our monthly payments and how much we essentially have to pay overall back to the lender. Okay, so remember, you get different types of mortgages. You get a variable rate, and that varies with that Bank of England base rate, the interest rate. So if you do that, your monthly payments are going to vary every month. Okay, sometimes they might go up, sometimes they might go down. It depends on what that base rate is. Right now, as of March 2021, the Bank of England base rate is the lowest that it's been in a long, long time. Okay, and that is good for borrowing money. So you may hear people saying it's a good time to buy. Well, that's because the interest rates on mortgages are extremely low, which means you don't have to pay as much back in interest. Okay, but so you can get fixed rate mortgages for shorter time periods, which fixes that kind of smaller rate. But then if it goes down even more, you may be losing out on money. So what we're going to do is pause the video just now, go to the BBC mortgage calculator, and we are going to input this information. So the repayment period is 30 years, so we're paying it back over 30 years. That's kind of standard for a mortgage. It's £50,000 that we're borrowing, and we're going to try it when we have different mortgage rates of interest. So 3%, 5% and 8%, and how does that affect your monthly payment? So go to that BBC mortgage calculator and get those three values now. Okay, so hopefully you managed to get those three values. Quite startling differences, I think, as you increase the interest rate over a 30-year period. How big the monthly payments can be. So at 3%, the monthly payment is £212.58. That's what it gave me. If that was to increase just by 2%, it doesn't sound like a huge amount. That goes all the way up to £271.04. So an extra £60 a month, which, if you times that by 30 years, is an awful lot. And then if we just go up again by a further 3% to go up to 8%, that increases it by almost £100 a month, £270.11. So any interest, you can see how drastically an increase in the interest rate for your mortgage can have an impact on your monthly repayment, because basically it means you are having to pay not only back the money you owe, but you're having to pay back interest on top of that. So the more interest you pay, the longer it takes to pay you back, or the higher your monthly payments have to be to stick to that 30-year mortgage. Okay, and I would encourage you to go out and ask, if you have any family members, older relatives that have dealt with mortgages before in the last sort of 30, 40 years. If you speak to anyone who's bought houses in the kind of 80s, 90s, at some points interest rates were up at 10 to 15%. So massive amount of interest rates, which meant people were basically having to spend their whole income just on paying back their mortgage. Whereas now interest rates are at an all-time low, 1.5%, 2%, that sort of thing. So it means that it is sort of a better time to have a mortgage. You don't have to pay as much back for your monthly payments. Okay, so hopefully that's a good bit of info on interest rates. It's good for when they go up. It's good for our savings. But when they go up, when we borrow money, it can be very, very bad and very dangerous. Okay, so that is, you can now completed the personal finance course. You should be ready to now do practice assessments. And once we've done sufficient practice assessments on the computers, we will be assessing for real. Okay, so now it's just a job to summarise everything we've done over the 2 units and do some practice assessment. So I hope you've enjoyed this course. I hope you've learned even a few things about money that you didn't know before, and you can discuss these things with your parents or your aunties and uncles, your grannies and grandpas, things that words like inflation, words like APR and direct debits that you maybe had heard but didn't really know what they are. Well, I hope that you now have a better understanding of that and are better kind of equipped for future life.